Hello everyone, welcome to Bankers Forum series on tax planning, and this is the second video in the series, and it is all about tax planning through PPF and tax saving fixed deposit. Now in our earlier video we have discussed the various options of planning your taxes, and among the most popular uh, PPF and tax saving FDs are the ones, so we'll be discussing them today. Coming on to Public Provident Fund, it's a very old scheme of Government of India, and the main eligibility criteria for this scheme is you need to be an individual or a minor, but keep in mind that NRIs are not eligible to invest in this scheme. The minimum and maximum amount of investment in this scheme are minimum amount of 500 and maximum of 1,50,000 per annum. Now the tenure of this scheme is 15 years with an option to extend it by 5 years at a time. Then there is nomination facility in this scheme where you can nominate a legal heir or any nominee of your choice. The rate of interest applicable in this scheme is determined by the Government of India from time to time, and we'll be showing a historical development of the interest that is paid in PPF. You can deposit in your PPF account uh, either in lump sum or in monthly installments, but the maximum number of deposits in PPF account is limited to 12. And in case you did not deposit any money in your PPF account in a financial year, a penalty of rupees 50 is applied. Please note that the interest is paid on annual basis in PPF accounts, and the amount that is considered for interest payment is the lowest amount that is in your PPF account between 5th to the end of the month for every month. For example, if you have deposited an amount of 10,000 in your PPF account on the 3rd of any month, then that amount would be considered in the monthly calculation of interest. But if you are paying rupees 10,000 or whatever amount you have done after the 5th of any month, then the total amount for interest calculation would not be considered for that month. Okay, the government has also introduced the scheme for transferring your PPF account from one bank to another, or from a post office where your PPF account is maintained to another bank or post office. Coming on to the withdrawal options, there are various options through which you can withdraw your PPF amount. The first is after completion of the 15 years, when the PPF account matures, you can withdraw all the money along with the interest. And the one peculiar thing about PPF is it is based upon EEE model, that is exempt from taxes. Therefore, the interest income that is earned from PPF account is totally exempt from income tax. The second option is after the completion of 5 years, there's an option to remove 50% of the amount that is lying in the account in the preceding year. So you can withdraw the part of the amount after the 5 years. Then there is also an option that after the maturity of your PPF account, if you have chosen to extend the account by 5 years, you can withdraw up to an amount of 60% lying in your PPF account and extend the balance amount. Lastly, there is an option for a loan against PPF, but it requires your PPF account to be less than 5 years old, and you can avail an amount up to 25% of the amount lying in your PPF account, and the duration of such loan is 36 months, and the rate of interest applied is 2% per annum. But there is also an option that if you don't repay your loan in 36 months, the applicable rate of interest is 6% per annum. This is just a table showing the applicable rate of interest in PPF accounts. Now, since the rate of interest applicable on PPF is determined by the government, any bank or post office does not have much say in it, and it is revised from time to time. Okay, now moving on to the tax saving fixed deposits. Main guidelines regarding these fixed deposits is that the account is open for 5 years, and there is no restriction regarding the minimum amount one can invest in such fixed deposits. but the tax benefit is limited to 1,50,000. So if you are depositing any amount more than 1,50,000, the tax benefit that you will be getting in your annual taxable income is only 1,50,000. Now, for other provisions, nomination facility is also available in this product, and the rate of interest is generally determined by respective banks as per their internal procedures. Special things to note about tax saving fixed deposit is that premature withdrawal or closure is not allowed in this FD, and banks also does not allow any loans against these fixed deposits. Also, there are guidelines regarding that auto renewals are not done. This is just a general table showing various rates of interest in different banks for tax saving FD. Okay, this shows just a simple comparison between PPF and FD. The main differences are in terms of the tenure, that PPF is an account that you open for 15 years and tax saving FD is done for 5 years. Then nomination facility is available in both the facilities, and in terms of midterm withdrawal you cannot withdraw your tax saving FD midterm, but there are certain provisions where some amount can be taken out of PPF. Then PPF account can be extended after its maturity, but tax saving FD is not auto renewed. About rate of interest, in PPF the rate of interest is governed by the rules of the government, while in tax saving FD it is governed by the bank's internal procedure. Lastly, PPF accounts can be transferred between different banks or post offices, but tax saving FD cannot be transferred between banks. So these are the main differences between PPF and FD, and we believe that this video would be helpful to you in many ways. We'll be coming up with more detailed analysis of other types of investment options that can help you save taxes. Till then, please share and subscribe to our channel. Thank you.